Welcome to tonight's sessional meeting, which sees life insurance at the crossroads. Tonight we are broadcasting live to the world, I believe. The sessional meeting is being live streamed to those who have signed up. I'm informed there are approximately 100 registrations, including people as far apart as India, where it must be about 11 o'clock at night, Hong Kong, where it's well past midnight, and Ireland, Germany and Belgium. Such is the attraction of the people at the top table this evening. Now, we turn to the topic of tonight's discussion, which is life insurance at the crossroads. This is given by two working parties this evening: the value of with profits to consumers working party and the impact on consumers of Solvency II and low interest rates working party. Our first half is the value of with profits for consumers. We have Tim Bateman from Mazars. Tim is a partner in Mazars Actuarial and Risk Practice in London. He's worked in the with-profit sphere since starting as a trainee in the 1980s. He currently works with a number of with-profits companies, including acting as reviewing actuary for Mazars' external audit team, and he's the chair of the working party reporting here today. Catherine Thorne works for Prudential, and she's spent much of her career working in with-profits, including 4 years as the deputy with-profits actuary at Prudential, 4 years working for the WPA at Standard Life, and 3 years in Standard Life working in Germany and Austria. She's very interested in how we as an industry can improve consumer engagement. She's also keen to push the profession's thinking forward in this area, as well as being challenged in her own views. That's a good thing to write, so you have to challenge her this evening, dear. She also serves as my deputy as chair of the Scottish Board. Ross Thompson from Standard Life is responsible for review and development of Standard Life's with profits methodology and administration. He's previously worked on testing and validation of Standard Life's actuarial modelling suite and started his career in with profits management at Scottish Widows. With that, who am I passing over to? Us. Us. The three. All three of you. Thank you very much.
Right, good evening everybody, and thank you all for inviting us along here this evening with my two fellow members, Catherine and Ross. We're going to just fill you in on a little bit of background of the activities of our working party. There will be a good time for questions at the end, but we do want to have a little bit of interaction, and to start things off, we found one or two, intriguing bits of customer behaviour as we went through the survey. We probably learned more about doing surveys in some ways than the actual responses themselves. But here's one question: how often do consumers review their financial product? We asked our with profits policyholders in the survey, so there were 2,800 odd respondents, of whom 473 owned up to having with profits products. How often do they review their financial product? And there you see that there's a good chunk of them look at it every 6 months, maybe more frequently. Another good chunk looking at it between 6 months to a year, and then down through the scales. We then asked a slightly different question, which was, how often would you like to review your financial product? Now, to make sure you're all awake and listening to me, I'm just going to give you two options. Do you think they would want information more frequently or less frequently on average? So hands up for more frequently, and hands up for less frequently. Yeah, it's a pretty sort of even mix, maybe slightly more to the more frequently, and it turns out it is slightly more frequently. So, and this is, we believe that if you ask people an aspirational question, how often do you think you should look at your information, they're going to give you the answer they think you want. They think you want them to look at it more frequently. So they sort of give you the good boy or good girl answer. And this informs, I think, some of our questions for the next survey we want to do. Let's get back to basics. So in the next 20, 25 minutes, we're going to run through a little bit on, I'm going to give a background, Ross is going to talk about customer engagement, and then Catherine is going to finish off with a slightly different look at analysing what customers tell us and what they tell us about what they want. So background from me, I probably don't need to tell you too much about why with profits funds have been in the background, in the news for all the wrong reasons. Zombie funds, endowment scandals, they've been all over the news, and the brand has got a bad name. And one of the questions we were trying to find out was, has it completely tarnished the name, or is there still some life and some value in this product? And I think when Zilling and Birchin stand up later, they've got also a bit of a spin on the with profits side, and we'll be interested to see what you make of their take on the with profits concept. We had a look at past performance, and we were quite interested just from a 20-year return comparison. What did the raw figures show us? And actually, with profits, unit-linked mixed fund, pretty similar, not too bad on average. However, when you look at the extremes of these, you find that the with profits fund, the performance will tend to depend very much on which particular fund you've been invested in. And then good performance will definitely depend much more on the expectation of the customer from the outset. So the next thing, having looked at the performance, we looked at what information do customers get, benefit statements, and we looked at a range of 30 to 40 different benefit statements to try and work out what was similar, what was different, what we thought might be good practice. And we came up with a number of ideas about what good content might be, how some companies have dealt with the jargon that's inherent in some of these communications. One thing that was very clear was that consumers aren't being told a lot about how investment strategy is changing over time. And the very final thing that we found was, as we looked for existing research into what consumers actually think themselves, there wasn't any, very little. So we commissioned a survey through the Institute and Faculty of Actuaries with the purpose of trying to get a better idea of how to engage with consumers and what we can do to improve communications. We wanted to ask them about whether they understand their products, whether they understand the value in their products, and what information they get about their products that they value and what they don't want to know. So, as I mentioned earlier, the survey covered 2,851 respondents, of whom 473 had with profits products. The fieldwork went on last November, and the analysis we got split by all sorts of which ways, probably more cuts of the data than we've had hot dinners. This one I've just put up as an example, and to show, when I was first looking at it, I was thinking, well, that's about 2/3 of the population are, 55 plus? But perhaps spinning it around the other way, 1/3 of the population is below the age of 55. It's a challenge, I think, for the with profits industry is getting down into the lower age groups. Enough from me. I'm going to hand over now to Ross, who's going to talk a bit more about the customer engagement side of things.
Thank you. So before we get started on the survey results in too much detail, I just want a few caveats about the survey in general. There could be an element of self-selection, so results could be somewhat skewed by people with a very strong feeling about with profits one way or the other. So we've taken that into content. And also there might be an element of, as Tim's touched on, about sort of right answer bias, about people saying what they think is the answer they're supposed to give rather than necessarily what is their correct answer. So we're not really taking any of these statistics as gospel, we're just looking for underlying themes and ideas of what we need to focus on in future. And one final caveat is I've got quite a heavy cold, so I could have a coughing fit or a nosebleed at any point, so it could get exciting. So first thing I want to look at is why people had with-profits in the first place, what drove them down that road. And grouping results together, over half of, or pretty much exactly half of the people in the survey made a conscious choice to go into with-profits. That's based on some element of personal research. They chose with-profits as being the right thing for them. A little over a quarter of people were advised, either professionally or through family and friends, to go for with-profits. And a little bit fewer, there was no real option. It was either the default option for the pension or it was compulsory to get their mortgage. So that's what drove them down with profits. So if we want to look at the conscious choice people in a little bit more detail, you see that 42% of those people thought it was the best option available, having done some research. And around about a third of people said it met their investment objectives. So this is a lot of people spending a lot of time making sure that the with-profits product was the right for them, it met their needs. And 11% of people just like a pretty lady in a long black cloak, so they bought it because of that. So people seem to have been engaged with profits and the reasons why they bought the product in the first place, which is a good thing. Has that continued throughout the product's lifestyle? So a quick question, we asked people whether they were likely to keep their product until maturity or after. Does anyone want to shout out what percentage of people think they would keep it till maturity or later?
80.
Yes, it was 80. You were supposed to go lower. You were at the Standard Life session. And they were, yeah. So yes, exactly 80%, exactly 80% said they would hold it to or after maturity. So people are in with profits for the long term, with a small number that don't know, or a very, very small number would surrender early. But is that loyalty to the product? People still value the product they've got? Or is that some level of apathy? The value is so low it can't get any worse, I might as well stick with it. Or is it a fear of maybe exit penalties if they go early? There's a certain barrier to doing so. So looked at that in a little bit more detail and said, if there were no exit penalties, what would your actions be? And as you might expect, there was fewer people said they would leave early. So 64% of people are unlikely to surrender early if there was no barrier. So it's still a little bit lower, but still a lot of people are keeping with profits until the very end, which is reassuring for people like myself who work in administration of with profits. So, but are people still so engaged with the product? They're engaged at the outset, they're going to keep it for the long term, but are they still so engaged? So we asked customers what they'd like to see in their annual statements, what pieces of information. And there's a wide variety of responses, and you can see there's some of the top answers there: investment performance, current cash in value, change in value. There's some of the more obvious things that anyone would like to see. Possibly worrying for anyone looking to implement MiFID II is that 48% of people want to see the charges incurred on their product, so no pressure there. But some of the lower down responses are some of the things that maybe as a risk-averse actuary you think would be possibly higher or more of a worry. So the risks, the guarantees, how to improve the projected position. So just picking out a few of those answers in a bit more detail. 47% of people said they wanted to see the projected maturity value, but only 32% said they actually want to see how to improve that, either through change in fund choice, extra contributions and so on. So there's a little bit of a disconnect between what people want to see and sort of the actions that might drive from them. And similarly, it's just over 60% of people wanted to see the current cash-in value, but less than 30% of people wanted to see what value of the guarantees underpinning that was and to have those explained. So again, a little bit of a worry if people are looking to know the current value of the product, but there's a possibility they could be losing out on valuable guarantees if they were to make the wrong choice. So sticking with customer loyalty and sticking with these answers, but grouping them slightly differently. About 40 of all the information people want to see, some 43% of it is sort of backwards looking information. What's the current value? What premiums have I paid? What charges have I levied? And only 23% of that is anything actually action or awareness related. So that's the risks associated with the product and the call to action for changes to investment strategy or contribution. So a little bit of a worry that people seem to be very focused on the background and not thinking about the future. So we asked customers then what they would like to see as they approach maturity rather than in their annual statements. And you see it gets a little bit more admin focused there, but some 53% of people now saying they want to know what their options are, they want to know if they can change funds, they want to know if they can change the contributions and so on, whereas only 32% of people said they want to see that in annual statement. So it's a bit of an increase later on in the lifestyle of the product. And part of that could well be lifestyling and people wanting to change into sort of de-risk their investment and so on, but still a lot of people suddenly want to know what they can do about it to improve the position, and it could be a case of the horse has bolted. Moving on to customer understanding, we asked customers what the benefits of having a with profits product were in their view. And some of the higher scoring answers were, yes, they were correct answers, things about potential long-term growth with inflation protection, reliable growth, tax efficiency. They're all correct answers, but they're not specific to with profits. They're things that there's a number of alternatives that could have delivered that as well. It's really when you get down to guarantees and smoothing, less than 20% of people said they saw that as a benefit of with profits, whereas people actually working on it know that that is some of the key benefits of with profits. So there's a little bit of a disconnect between the provider and the customer possibly there. Possibly need for something of a sales job on guarantees and smoothing. So sticking with customer understanding and moving on a little bit to the value of the product and the options and guarantees that people have, we asked customers how well they understand that, and some 53% of people said they did not understand how their cash in value could change. So people get an annual statement and then 6 months later they log into their app or they phone up for a surrender value and they do not understand how that value could have changed. And similarly, 59% of people didn't understand all the options and guarantees associated with the contract. Now, you could pick out the word all in there and say there's a bit of a failure in the question, because do I understand all of the plot points of Game of Thrones? No, I don't, but I understand the majority. So even if you take out a few of the pedants in there, that it's still a lot of people do not understand the options and guarantees within the products that they have. So what does that mean for customer communications? And what more can we be doing to improve on the descriptions of the product and how it works? We finish up a few last-minute stats from the survey, other unusual, surprising results. There's quite a high understanding of terminology, if we believe the survey results. So around about 60% of people understand what we mean by final bonus and regular bonus, which is reassuring. But some 30% of people said they understand what MVR is, so it's also take it with a pinch of salt. But understanding the options available with the product doesn't seem to increase over time or with age of the product. So people approaching retirement don't seem to understand their options any more than people in their 30s and 40s. We also found that 40% of people don't seem to understand the implications of cashing in early, and that harks back to people want to know the current value, but they don't want to know the guarantee, the value underpinning that, which is also somewhat of a worry. And final little stat is that 18% of people said they would review their product never. So it's not 5 years, not less than 5 years, it's never. So they've got product and it's going to stay there. So again, a bit of a worry for customer engagement. So in summary, customers knew why they got with profits in the first place. They got it for a very specific reason, and they're sticking with it to the end. But what more can we do to be helping improve customer engagement and customer understanding and really get back to focusing on the customer needs? So I'm going to pass over to Catherine now, who's going to talk a little bit about what more new and interesting things we can do in the space of understanding customer needs. That bit more.
Bit of a worry to be introduced by saying you're going to be interesting, but I will do my best. So, as we've talked about, one of the things we were interested in for a working party was the potential disconnect between what we think as providers and what our customers might be thinking. And the very high, we had quite a debate in the working party about the very high reported customer understanding of some terms and whether we thought customers were really giving us the answers that they thought they ought to give or that we wanted them to give. So in the survey, there were some questions where we just asked open questions and also some questions where there was an other box where customers could write in free text in their own words. And I find that quite interesting and quite a rich source of data. And I think throughout my career, I've always been quite surprised at the amount of stuff some customers will tell you. So thinking back to the Working Party's aim of understanding what customers value and how we can improve customer communications in their language, I looked at a tool that would help us analyse these free text responses and give us some insights into what customers were thinking with the help of a data scientist. So the model that we used was a model that was trained on 82 million Amazon reviews. So the model was trained purely to predict the next character of text from Amazon reviews. So irrespective of how people spell or what words they use, all the model was trying to do was predict the next letter of the text. But when it did that, it actually had to learn a lot about English language and English structure, and given Amazon reviews, it became very highly predictive of sentiment in text, just looking at it character by character. So I will show you, try and illustrate in the next point how this model works. So this is purely to show you how the model works. This is a review of a film. The reviewer likes the book but really hates the film. So I do apologise to any colourblind people in the audience. Green is positive sentiment and red is negative sentiment, and the depth of the colour, stop the animation, is the strength of the sentiment. So the reviewer likes the book, it's all green at the start, thinks the book is great, but goes on to absolutely hate the film. So focusing on the last two sentences to show you how the model works. So the second last sentence is, the book is really, really good. So that is obviously a positive sentiment, but because the model is looking at it letter by letter, it doesn't know that it's a positive sentiment until it reaches the end of the sentence. And by that time in the review, the sentiment is pretty negative. So you'll see the book is really, really good, is quite deep red, but then the sentiment changes and becomes marginally more positive until the movie is just dreadful and the sentiment takes a turn for the worst at that point. And that's the paper reference if you're wanting to read more about the model. So the purpose of this is just to show you how the model works. And so it doesn't read text as we do as humans, it's just looking at it letter by letter. So we use this model to look at some of the free text responses. So one of the questions we perhaps dangerously asked customers was, what do you like about your annual statement? So taking one of our positive responses, one customer replied, my provider has done an excellent job for me with my SIP and I get full annual information from my advisor who provides my monthly income. And the model rated that plus 1.1. One customer replied in response to this question, they are obliged to send them, like is not a useful word in this context. So this is our audience participation. So hands up for, is that a positive or a neutral sentiment? Negative sentiment? Anybody care to guess the number that the model gave that, given the other numbers? No? Minus 0.1? So just negative. So it actually gave it minus 0.6 seconds. So not as negative as waste of paper, but clearly not a positive sentiment. Some more examples in answers to the question, what do you dislike or would change about your annual statement? So I won't read out all the examples, but one customer responded, too lengthy, too wordy, too much legal waffle, layout very boring, small font, incomprehensible explanations, poor definitions, and too repetitive. So does anybody care to suggest a number that the model might have given that? Plus 2? Yep, very close. So that was the largest negative number that we got. The model isn't actually bounded for a range, because it is conceivable to have a more negative response for that, but that was the most negative response that we got into this question. As well as measuring sentiment, the model also generates a digital fingerprint of the text. So this is effectively a point in a vector. So similar responses are very close to each other in this vector, and identical responses are at exactly the same point. So after this, we looked at clusters of responses, so responses which were in a similar space. And we hope that this would help us identify themes that customers said. Again, totally using customers' words, not using industry words. So I think it may not be a surprise to you that no customer used MVR in their responses. So here, just to illustrate clustering, are two example clusters in the responses, and we termed the first one ease of understanding. So you'll see the first two responses in that. One is easy to understand and informative, and the clustering model put that close to clear, concise, and up to date, even although there's no actual common words between these two. But I think we can appreciate that they are a similar theme, so they were in the same cluster. And then another cluster was, I want to understand something about the value. So there was a value cluster. And this is a graphic that shows the clusters and also how the sentiment varies according to the clusters. So I've used the same color as in the animation. So red is negative sentiment and green is a positive sentiment. So taking as an example the cluster second in, so the one that's got 32 values, that was a quality of information cluster. So within that, the negative one at the bottom is it's difficult to find relevant information. But in the same cluster, but on the positive sentiment, was easy access, straightforward and clear statements. So it's the same theme, but a different sentiment. So clustering there's different ways that you can do clustering. So I'm not saying that this is perfect, but it's just, we thought, quite an interesting use of technology. When we carried that out, key themes from the free text responses that were important to customers in terms of the communications they get from us are clarity, it's easy to understand, it keeps me informed, I'd like some idea of its value, I'd like it available online, and there was a whole bunch of people who just didn't really have an opinion. So I think these techniques we're keen to use in the next part of the working party to allow us to ask customers what they value in their own words, and for us to gain some insights into what is actually important to them and how they feel about their product and potentially their provider. And techniques like this would also allow providers to measure improvements in their communication over time and potentially perform benchmarking. Technology is advancing incredibly, and these tools, I think, will very soon be able to be used real time. So they could be used at the same time as someone in a call center or a chatbot, and could then tailor the responses compared to how the emotions of the customer are during the call, and also look out for potential vulnerabilities. So I think that was all I wanted to say. I will hand over to Tim.
Thank you very much, Catherine and Ross. So just to conclude, With Profits has had a bad press. The returns are competitive. Perhaps we could do more to advertise how things are going. With Profits is an evolving landscape. We've gone from conventional products to unitised with Profits products, and I think the gentlemen on our right here are going to perhaps talk about a further new wave. Communicating with consumers is becoming a bit of a holy grail. Getting the right information to consumers when they want it, in a form they want it, and at a time they want it is highly desirable. Learning from them what they want is also very difficult. And some of the things that Catherine has been talking about in particular perhaps give us different ways of analysing the information we get. With profits, consumers, from the surveys we've done, or the survey we've done, seem to suggest that they understand with their product pretty well. Some very high levels of understanding shown. But there are other aspects of it that just don't seem to be quite getting across, or not getting as well across as we'd like them to. So guarantees, options, what happens as they run into retirement or maturity. And there seem to be a bunch of people who never look at their product. So our phase 1 report, which we are about to put on the website, looks at some of that background, some of the things the communications we've examined, gives some ideas from our perspective of what we think good communication looks like. But what we would like to do in our next steps would be to engage much more with industry, to talk to providers, and to do a second survey. We've got responses from 473 with profits policyholders, and we'd like to broaden that out. So we are going to be writing to providers to see if we can engage in a further round of surveys, to see if we can get slightly richer information, as Catherine says, to get hold of some of this. What do they actually tell us in their own words? What can we gather from that? And some of the ideas that Ross was putting forward about what do they want to know about options and guarantees. So we'll be inviting we'll be inviting companies to participate. We're hoping we'll be able to do some very simple benchmarking, and then we aim to engage with the FCA as they are continuing to look at their a study with profits issues. If you have any questions, then please contact any of us. But now I think we are done with the formal part. We shall take our seats and take any of your questions. Thank you.
Thank you for that. Now, discussion will be open to the floor. Can I test the waters and who's likely to want to ask a question? And at this stage, I'd like to see a forest of hands. So, as many as that. Right, okay. We'll get some questions anyway. Can I remind you that the meeting is being recorded for publication, and please wait on the microphone coming to you, and please state your name before you ask your question. Can I invite you to the first questioner, please? Someone put their hand up. They're just...
Thank you. It's Carrie Johnson. Can I ask, there's quite a lot of the questions in the survey you could have asked a unit-linked customer. There's some of them were specific to with profits, but most were actually quite general. Of your 473, did you discount the ones that didn't say they had with profits, or did the other people answer the questions as well? And if not, is that something that would be worth looking at so that you could see the difference between with profits customers and unit-linked?
So the 2,851 respondents had a bank of questions which they all answered, and then there were a separate set of questions for people who said we have a with profits policy. So at the end of the day, it was there was a selection process which only the with profits people got the second bank of questions. But we have got quite a good deal of information from a broader representative sample of people who said they had a financial product, which could be an ISA or a unit-linked product or anything else. So we've sort of got a broader benchmark to compare against.
I
think for the second stage, we're thinking of just putting a questionnaire to with profits customers. So kind of sticking to the reference of the working party, just sticking it with profits customers.
That sounds like an opportunity for some other people to invent another working party, though. Have we another question? The front here.
Hi, it's Tony Horn. Did the Working Party consider the effect of more information on the customer behaviour? So take a hypothetical case where all customers have perfect knowledge of the value of guarantees, surrender values, etc. Would that make the concept of with profits break down through that? Whether the word anti-selection is the right term or not. You probably understand the question.
I think we probably struggled quite a bit with trying to ask the right sort of questions for the with profits policyholders, or for policyholders more generally. I think I, for one, and I think others in the Working Party, were surprised at the numbers of with profits policyholders who claimed to understand things which, like MVRs, I mean, maybe not a huge amount, but they were still probably more saying they understood these things than I had expected, and a much broader understanding of the concept and the product. Admittedly, we didn't test this. We were just asking, do you understand? So there was no challenge to say, do you really? It was, do you understand? So you have to take that with, as I think Ross said, a little bit of a pinch of salt in some places. But it's, I think, having done the first survey, we've learnt a lot about how to conduct a better second survey, trying to be more accurate or try to probe the real areas we would like to probe with policyholders. I'm not sure that answers your question, actually.
Yeah, I think so. I mean, there was a Working Party around 20 years ago, transparent with profits, something along those lines. So it's about what would be the effect of making with profits transparent, publishing the asset shares, for example. And I think the general feeling was maybe, with profits, the concept would actually break down. And if that was the case 20 years ago, now with the increased information available and the increased expectations, maybe it would. So maybe there's a sweet spot with, if there's a little bit more knowledge without a completely detailed understanding, maybe that would improve the performance of the product and the demand for it. Yeah. But maybe too much information maybe wouldn't be a good thing, but maybe next step.
No, I think you're hitting a very interesting area, which I think Zilling and Bircham will be touching on in their session. That, is there a sweet spot where something that's a bit more transparent and has a number of options and guarantees, or things that look like options and guarantees, might be more attractive to a modern generation of financial product buyers? Very interesting subject, and you can ask that question to them at the end and see what answer they give.
I'm not sure you're allowed to sort of suggest that the other lot have to answer it as well.
I'm forewarning them.
We have another question at the front here.
My name's Derek Pike. I'd like to pick up on this finding that policyholders don't value their options and guarantees, and I wonder if that's because they don't really understand the volatility and risks that they're exposed to, and that in spite of all the financial crises we've had in the last 20 years. They still look to the future from a single scenario. And I assume that these projections are done on 2 or 3 growth rates, but I wonder if it would be more useful to actually illustrate some more extreme scenarios in order to bring out the value of the options and guarantees. But I don't know if that's something that could be explored in a policyholder survey.
Yeah, I think, one of the things we are keen to understand is what information policyholders would find useful. There's some feedback which suggests they get, in amongst all the other data, they get too much. There's too much information there. But clearly, some providers are giving policyholders information which they do value and getting it across quite clearly, and trying to sift through those different, that range is tricky. But I think for the second survey, we would like to see if we can explore that a little bit more. I think policyholders probably do like the idea of guarantees, but generally they don't like the idea of paying for them. But Catherine, you've got some views.
Yes,
here,
I think maybe Ross has the stat, but a lot of customers didn't understand their guarantees, and I think if they don't understand them, it's quite hard for them to value them. And so I think understanding is the first point.
Yeah, I think it's about 30% of people 59% of people didn't understand all of their options and guarantees. And I think as well in the survey, we saw that less than 20% of people see the guarantee as a benefit, and that could just be that it only kicks in when things are really, really bad. So is it a benefit, or is it after the horse is bolted, that sort of area? And similarly, smoothing can be positive, can be negative, so do people maybe not see it as a benefit because it's two-sided?
Yes, I'd have expected a lot of policyholders to have a concern that what happens if financial markets really break down and there's a real financial crisis.
Yeah, I think it's that balance between giving them useful information in an intelligible form, and then just overloading them with all sorts of useful things that they might find interesting. It's what do they really want to know, and what do we? I mean, some of it is what do we think they should know as well, and trying to split the two out is a challenge.
Thanks.
There's a hand at the back. A man that looks like John Taylor.
Thank you. It is indeed John Taylor, Alan Watson, thank you. Question harking back to the endowment crisis from must be well over a decade ago now, and I'm mindful at the time that this was unfolding, many providers were content to rely on the fact that statements did indeed tell customers that their kind of prospective payouts were diminishing and their mortgages may not be paid off. But of course, it was a very particular type of endowment customer that actually read the statements in detail and understood them. And it was only subsequently when the FSA, as it was at the time, mandated that red, amber, green statements should be issued to customers that many sat up and took notice at that point in time. So I'm just kind of wondering how statements have evolved since that time, and whether they are indeed more valuable and understandable to customers than the endowment statements of 20 years ago.
A very good question, which means I don't really have a good answer for you. I think the information contained in statements is probably more comprehensive than it was at that time. Question as to whether it's more comprehensible. I think there is a lot more information for policyholders should they care to read it. Whether there's enough of the forward-looking aspect of it is probably still better than it was, but I'm not sure our survey has helped me with that. Perhaps others have thoughts.
I think I would say that even if statements have evolved, I think customer expectations have also evolved, and customers' tolerance of getting communications that they really can't understand, given what they get from other companies has changed. So I think probably statements have evolved, but I feel maybe not as much as they should have done.
I think on that theme, I'd ask, did you get, were some companies clearly better than other companies? You might not want to name names here, but you know, were some companies better than others, or was it just a mix?
I think when we did our sort of benefit statement survey, we felt that there were some companies who were presenting information in a way that seemed very helpful. They had clearly thought about how they wanted to present it, and it came across as well thought out and clear. And that, for me, is a sort of a big tick. And I think that, you know, it's only our views. We're not final arbiters of anything, but we thought there were some companies who seemed to have taken a step forward, gone into perhaps more graphical representations, and they had made a difference in their communication.
But in terms of the survey results, we didn't know what companies any of the customers were from. So the survey was blind as to, we just knew they were with Profits customers, or they weren't. We didn't know what companies they were with.
Another question? Keith?
It's Keith Miller. Thanks for the survey, it was interesting. Just a quick question on how you got your sample. I didn't catch that at the start. I take it wasn't actuarial members that was your start point, but I'll let you answer that one separately. But just I'm interested in the points about the understanding of the facets of with profits like guarantees, options and smoothing. I had some experience of reviewing past advice on with profits and other products, and I recall that often with profits was recommended on the basis of smoothing being particularly loved by customers. And I think that's if you ask the customer, would you like a smooth return or would you like a jagged return? Most customers would say they would like a smooth return, I think. But it's relative to what? I think is the question, how much does it cost, or what is it relative to? Because most people love smoothing. I think if it's, I want my returns to be smooth, that sounds like a good thing. But it's the how it's explained by someone up front and at a later stage, and what it means to the customer is maybe not the same as what it meant to the company.
To answer your first question, the survey was open to all YouGov members. I think there's several hundreds of thousands of members, and they were whittled down once they said whether or not they had a financial product. Then they were kicked out if they didn't have one, or they carried on from there. So as far as I know, there was, well, we don't know, but there have been very few actuaries involved, I'm sure. To answer your second point, I totally agree with smoothing. You can illustrate it any one of a number of ways, but unless you show that smoothing holds back in the good times as well as protection in the bad times, then it can lead to misunderstandings and people thinking it's always a good thing. So you'll have to understand that smoothing tends to pay for itself, and therefore that's the cost you pay there.
Another hand is up there in the middle. I can't see who it is though, I just see a hand.
Hiya, Doug Philp. I was just wondering about whether or not the people responding to the survey had a common understanding of what financial product is. Because, I'd have thought a financial product would be a credit card, a bank account, a mortgage. There's a whole variety of financial products. And then the question about how frequently they would review these financial products must be a function of what they consider these financial products to be.
Yeah, we tried to whittle down, I think was the expression that Ross used just now, the population from anybody who had a bank account or a savings account, to narrow down to ask more specific questions about, was it a pension product, a savings product, an investment product, with profits unit linked, non-profit. it was quite hard in a survey to be as clear as you might want to be, or you could be face to face. Would have been in many ways much better to be face to face, because you could test whether or not your questions were getting a blank look or a yes, I understand what you're talking about when you say the word with profits. So we did try and tailor the question to try and eliminate those who just had bank accounts and those. How successful we were is unclear, but I think, believe we did a reasonable job.
So we did ask in the survey, there was a question for what is the main financial product that you're answering the survey around, and you know, what is it? And so we could look at the data by people who had ISAs, pension, annuity, savings product, and one customer who used the other box for describing their financial product replied, a complete and utter rip-off, and I didn't need my model to measure their sentiment. But there was a question where people could say what product it was they were answering the question with regard to, so we could split the data out that way.
The front here.
Thanks. Brian Duffin, just two aspects to raise. At the beginning of the presentation, you showed how important advisors were in setting up the policies, but that isn't something which you were able to track going through. But that would be an interesting area to pursue, although it's very difficult, because on the one hand, the industry sells some of the products as being simple and don't require continuous advice, whereas other aspects, typically pensions policies, are normally involved with a regular advisor review. But it's in other walks of life, we don't try to understand every service we receive in detail, whether it's medical or legal or whatever. We rely heavily on advisors, and the interaction between advisors and customers is something which would be interesting to explore, and whether there are better ways of doing that. The second aspect is that I didn't see an overall satisfaction index. I mean, typically when you do these surveys, you're asked, and would you recommend this product to your friend or your mother or whatever? And it'd be interesting to know whether there is a general satisfaction, even though there may be a limited understanding of some of the aspects with the policies. The average customer wouldn't be able to give you an answer whether they'd even be better off doing something else, whether unit-linked or unit trusts on a platform or whatever. But whether they feel that they've had a reasonable deal would be an interesting question to ask in future. And finally, to say, well done. Designing surveys from scratch is a very difficult process. And as you said, getting the psychology of the respondent and trying to extract the answer you really want is not easy, but well done.
Thank you very much. I think you've raised another couple of good questions for our second survey there, and we'll certainly take those thoughts on board, because definitely the first survey was best endeavours, but I think we could probably do better next time.
I agree, it would be very useful to see how the engagement compared if you had people that had been advised and still had an ongoing relationship with their advisor, how their engagement compared with those who had done the background research themselves. I think it's maybe something we could maybe ask YouGov if they can cut the data that way.
I'll let David here ask the last question of the working party before we move on to the next working party.
Thanks very much, Alan. You're all heart. I was going to ask two questions. I don't know whether I'm allowed to, but I'll go on ahead until you interrupt me. It was to do with two topics. One was, I think I heard comments about unintelligible annual statements. And I suppose it reminded me of the fair, clear and not misleading requirements that we're all under in customer communications, and I wondered whether there was scope for the working party to, if you like, share best practice and perhaps worst practice going forward. A lot's been done on how to communicate pensions effectively to people and what sort of words to use and phrases, and maybe something similar in the with-profit space could be a helpful contribution to the public interest. And the other point that I wanted to raise was, I think one of the early slides that showed the average return and the spread around the average return showed quite a narrow range for unit-linked and a huge range for with-profits, which made me wonder whether the unit-linked was just for a managed fund or whether that allowed for variability in specialist funds or not. But perhaps more importantly, going forward, is it treating customers fairly to offer a concept where if they picked the wrong company, they could get 1/10 of the annual return to what they would have got if they picked a better company? Are customers really equipped to make those sorts of investment decisions? And is it an appropriate product that's got that amount of variability in it? I say that as a fan of with-profits, but that slide did concern me.
Thank goodness you only asked 2 questions, that's all I could say. I think on unintelligible and annual statements, what we've tried to do is to pick out areas that we thought looked like best practice to us. So our phase 1 report will have some examples of what we think worked. I don't think we're going to be in a position to say what we think didn't work. So we're trying to focus on raising standards and getting people to move in a positive direction. Yeah, you raise a very, very good question about are you the lucky person who chooses the right fund, or a very good philosophical question, which I think I will take with you over a glass of wine later. Thank you.
Right, thank you for that. I hope the working party number 2 have taken the hint that it's their turn up now. Can I introduce them? This is the impact of Solvency II and low interest rates on consumers working party. We have Zhiling Zhang of Lombard Odier Investment Management. He's Solutions Manager at Lombard Odier Investment Management and is a life actuary and CFA charter holder. He works in identifying investment risks and providing balance sheet solutions for insurance and pension asset owners under different regulatory regimes of the world. Prior to joining them, he worked at different companies including Morgan Stanley, KPMG and Aviva UK Life. Borçin Arkut is Chief Actuary at Aviva SA and is the Chief Aviva's Life and Pensions joint venture in Turkey. He's been supporting the business in terms of financial reporting, capital management, pricing, strategy and inorganic growth opportunities. He was involved in the IPO of Aviva SA in 2014 and worked with the regulator in implementing the legislation for annuities in Turkey. Prior to Aviva SA, he worked in Aviva Europe, where his main responsibilities were on economic capital and MCEV/IFRS reporting of Italian and Spanish business units, and in various roles in legal and general before that. Gentlemen, it's over to you.
Good evening, everyone. It's a pleasure to talk to you. We are 2 speakers from the Consumer Impact Working Party. We like to use this shorter name than the longer one. We are a 6-strong volunteer group dedicated to the research focus of consumer value and how it is enhanced or destroyed by outside factors. These factors include the low interest rate environment, the Solvency II transformation, as well as the digital and artificial intelligence revolution, and many others. We are going to talk about our working party's collective thoughts on the challenges and opportunities facing today's life insurers in the context of how these affect the traditional consumer value propositions. We try to keep our stance independent from industry practitioners and the regulator. We want to bring out fresh ideas that are not fully covered elsewhere. As Bob Dylan once said, "And you know something's happening, but you don't know what it is. Do you, Miss Jones?" We would like to think that actuaries are not Bob Dylan's Mr. Jones, but the influencers themselves. Here's a photo of our working party. The executive summary, very clear. We think that the life insurance industry is facing challenges, coming not only from socio-economic changes, but also from other aspects. We will talk through about 6 megatrends. We call them megatrends because they will have, we believe, a fundamental impact on the way life insurers operate in the future and the way consumers perceive and interact with the industry. So, what are the traditional value propositions? We try to summarize them into 3 aspects: savings, protection, and business soundness. Savings means you get a meaningful long-term guarantee and a satisfactory return and peace of mind. That is very straightforward, and we believe that the unique element of life insurance saving comes from guarantees. Protection, very straightforward. That's the core business activity of the industry ever since. Consumers believe that the life insurance industry has the most expertise in pricing biometric risks that concern them. There are varieties of biometric risks, and they can be a concern to some people, but not to everyone, each kind of them. And we actuaries believe that the UK insurers currently provide relatively good coverage of these biometric risks. The last one, but not the least important, is business soundness. Business soundness, which means security, value for money, ease of doing business, and some tax efficiency. So what are the challenges that we are potentially facing today? I'll hand over to Berching.
So thanks, Siling. So we have 2 crowded slides. This is the first one. It aims to show the extent of change that we're going through as an industry as well as a profession. Some of the changes are the ones that you may know in your day-to-day lives, such as regulatory changes around Solvency II, and more recently IFRS 17. Maybe some others are from the EU bodies and the government around the way products are sold, or around the way pension freedom given to retirees and how they spend their pension pot. Given the interlinked nature of these changes, to be honest, it's difficult to see the true individual impact of each change. The principles for responsible investing is an interesting one. It's an UN body to support environmental, social governance issues. So perhaps in the medium term, you will see the impact around environmental and health issues. But more importantly, there may be an impact on the consumers. The millennials who were born between the 80s and 90s, they will be valuing investment advice and their decision to buy purchasing products around ESGs. So this slide aims to show what we are going through. So you would have new startup companies partnering with incumbents, investment venture arms. You will have global asset managers who are leading the way in terms of robo-advice. So when you think about these companies, so it's not really a threat, but more of a collaboration that we're seeing as an emerging trend coming through. However, if we were to collectively brand and name these companies, perhaps it will be more suitable to assume that these are partners for life, or service providers, rather than life insurance companies. So this takes us nicely to our next question, first question. So we issued an online survey. Unfortunately, we can't broadcast the results on real time, so we're talking through the results to you. So we asked, do you think that the life insurance industry is facing disruption? And as expected, about 80% of the audience thinks that we are, and 20% doesn't. So it is in line with what we have been going through. So it is true that the insurance industry is under pressure in terms of delivering value and facing disruption. And when you think about the word disruption, it's quite fundamental, actually. It moves you from your comfort zone. It challenges your background, even your experience. So it's a whole new world, in a way. The good thing about technological disruption is the benefit that it yields to the customer, arguably. And of course, any change brings its own risks, such as around cybersecurity and data protection. And when disruption becomes mainstream or commoditized in a way, it becomes a megatrend. We will now be talking about the megatrends that we see in life insurance in the future.
Thanks, Bertie. So now we talk about some concrete ideas, what the megatrends are. The first one is about asset gather and manage. And to be more specific, we think there is a potential threat coming from asset management industry taking over a large proportion of what insurance companies used to be doing. So as we mentioned, long-term investment guarantees are very important. They are almost a unique feature, value add of the life insurance saving products. These guarantees, however, are very expensive to write, and it is difficult to find the suitable backing assets to support them. These guarantees, they are very complicated. Well, there is a variety of them, from simple annual interest rates to point-in-time minimum values, and to highly complicated option-backed look-back guarantees. So, as we have seen, life insurance are retreating from providing such lifelong guarantees. This raises the question, if these guarantees are removed from the future savings contracts, why can't consumers just simply invest in asset managers' funds? And will that in turn mean the demise of a large proportion of the life industry? We have seen this trend already in the DC pension space. This used to be a place where it was dominated by insurance companies, but now at least, for instance, in the US, we see they are more and more dominated by pure asset managers. From consumers' perspective, this might not be a bad thing because they get a better deal. But from the industry and the actuarial profession's perspective, this means a mass reduction of asset under management and a downgrade of the whole industry. Some of the players might take a more drastic action of, for instance, exiting from the industry. You must have heard of the recent case where a large insurer has changed into an asset manager. So we consider this is, well, I personally believe this is something like a stochastic jump diffusion process. You never know when it comes, but when it comes, it actually happens and have a large impact. So we issued this question, do you think the long-term investment guarantee are dead, and therefore it is the end of the annuities and participating products? We can't show the answers here, but basically, how...
So maybe if I just share the answers to this question would be, so there were 4 choices. So yes, low interest rates are here to stay, and these products are not value for money to consumers, so nobody chose that. Secondly, yes, Solvency II is driving a hard bargain, so guarantees will continue to be expensive for the consumers. Around 41% of the audience chose that answer. The third one is no, the on-the-way interest rates go up, so these products will make a comeback. So about 12% of the audience chose that. And finally, no, Solvency II, arguably good or bad, is here to stay and will lead to the development of new hybrid products with potential higher upside potential. So around 44% of the audience chose that. I think when I think about this, so clearly the audience is not thinking macro-driven. Maybe the answers to C indicate of the likely increase in interest rates across the world. But I think the answer here is around regulatory-driven. And this is exactly why we are at the crossroads, because half of the audience thinks that Solvency II will not necessarily lead to product development and it will penalize business written with guarantees, whereas the other half, maybe more positively, thinks that Solvency II will lead to new product forms and new propositions, perhaps for customer benefit.
So it is really a complicated situation. So it was meant to be Solvency II that was the focus when considering this issue, but the macro environment added to the complexity. So do you think our profession is very clear about what to do? I'm not sure, because different companies are taking different actions. And there's a trend towards hybrid products, as I believe.
Yeah, I think that's more of a continental European thing. So the thing is, customers do prefer guarantees. You know, they value guarantees, but how do you give satisfactory guarantees in a low interest rate environment? So there are some product examples in continental Europe producing somewhere between with profits and unit-linked, and some dynamic asset allocation strategies such as the constant proportion portfolio insurance, again giving better customer results.
So this leads us to the next section, which links up with the previous working party's discussions.
Yep. So this is the with profits. So we think that with profits, after going all these all the issues that was discussed previously, will make a comeback. So we believe that some level of guarantee is valued by the customers, but it needs to be communicated in a simple and transparent way, and it needs to have a customer appeal. So the question that was asked to the previous working party around whether a lot of information is good or not. I think when you think about it, we see that now less is more by looking at the behavioral economic studies. So, and I want to touch upon the survey results, which wasn't shown previously by the with Profits Working Party around communications. So they asked around how would people like to be communicated, and older generation would prefer communication by email, whereas younger generation preferred communication by, older generation preferred by letter, whereas younger generation preferred email as a means of communication. So what this is actually an indication of potential of the digital tools that can be developed to better engage with the new generation, such as the millennials. So online smoothing decisions supported by behavioral economics tools can be effective customer management way. And Solvency II, with its loss absorbency capacity of technical provisions, can also help in terms of managing capital. But we think it's really is the other examples in other markets that the UK market can utilize on. So we asked whether do you think that with profits will make a comeback in the next 5 years. So the results to the survey is yes, so a third, just over a third, 34%, and no, 61%. Now, So perhaps if smoothing was transparent and formula-based, and customers would be more comfortable when they see their benefits going down as well as up. I think the survey results is a reflection of the bad publicity that the UK market had over the years.
So the next topic, megatrend, we identified is the possible utilization of so-called defined ambition in pensions. That's a relatively new concept, not so new in Netherlands, but very new in the UK. What is it? It is basically a hybrid scheme of DB and DC. The scheme is invested entirely in the traditional asset allocation. When pensioners retire, the scheme pays cash from the scheme itself rather than locking into annuity rates. And in 2015, there was some discussion in the UK, and the primary legislation was passed to allow such schemes to happen. But then the government kind of abandoned the idea, has not introduced the secondary legislation until very recently. So what happened recently is that Royal Mail has discussed and will possibly become the first UK company to introduce such a collective DC scheme. Why is it? Because there are arguably some benefits of such a hybrid scheme compared to pure DC or pure DB. As we know, the performance of a scheme can be attributed to three sources. Well, this argument is actually from a recent parliament debate. Three sources of performance of a DB scheme. Firstly is investment. Secondly, cost reduction. Thirdly, pooling of risk, so that everybody is sort of receiving more stability. So the hybrid CDC scheme is can be expected to deliver some benefits in both in all these three aspects. In terms of investment return, since the pensioners' payments are not locked into very unfavorable annuity rates, the scheme is having a higher expected return, and therefore long-term growth will be better. In terms of cost reduction, since the scheme is pooled, it should be easier to manage and perform risk management than individual segregated accounts. And pooling of risk means that you have some cross-subsidy between members. So this is the more controversial area where younger members might potentially subsidize older members when another financial crisis hits. So this is one of the obstacles to implementing such a scheme. But we asked the participants of their opinions of whether such a CDC, a hybrid scheme, can be the preferred way forward. And our answer is roughly half and half. So that is quite encouraging, because it is an indication of merit to better explore this hybrid scheme. And I almost think this is a parallel to the with-profit in the pension space. Of course, there are questions to ask. For instance, should there be the limits on the extent of cross-subsidies between young and old? Should there be limits on the extent of which benefits can be reduced? So this is another potential drawback. The pensioners' benefits can be reduced in really bad times. And this is why even the Netherlands people are not entirely happy with such a scheme. But it is better than promising something and then failing to deliver it, and then you use surplus arising to make up for the losses in the past. So, yeah, this is potentially one area to explore.
So, yes, this is a big buzzword that's been seen these days. But so, I want to start off by showing you this the logo. So, those who are careful enough would see that A and the yellow curvy arrow it represents the big online retailer. And by looking at the faces, I think most of you would recognize that it's Amazon that we're talking about. So we've imagined this would be the logo of Amazon when they set up a live company. But leaving the logo aside, let's look at the recent news flows around the partnership that's been done by Amazon, Berkshire Hathaway, and JP Morgan on the healthcare market in the US, which caused a considerable stir. There has been falls in the market capitalization of their competitors, insurance companies and other healthcare companies. And interestingly, the company that they've formed is for non-for-profit, and it's only for their 1 million employees. So there isn't an actual threat for now, but just the thought of it has caused jitters in the markets. So if you think about this slide, it's, well, maybe man or actuary against machine. Before the advent of this technology, it wasn't really possible to price the individual risks on a personalized basis. It was more like a correlate approach by looking at the historical data. One thing that enables this is the wearables, but there are discussions on how more effective physical tracking will be. And it has the potential of undermining the actual profession's key strength using statistical analysis of past historical data. So this approach is not backward-looking, it's forward-looking. So one way of thinking how this will turn out is by considering the empowerment of the consumer. The consumer will demand this information, and this will decide whether or not his or her risk is priced in the premium accordingly. So what if this is the new insurance model? Zeling, what do you think?
I think we have no chance winning against the big machines because actuarial models were developed hundreds of years ago when there were no fast computers, no clever algorithms, just a few pieces of paper. But now we have unprecedented computational power, and we have some artificial intelligence models that can detect patterns that humans cannot. So time has changed. Basically, if the big data technology companies build something that can price, that can underwrite risk, I presume it will be more accurate than any existing actuarial underwriting models because they have far more data and they have far more computational power. And I do believe that the market for very large protection covers will inevitably go down the detailed underwriting approach. Machines can be used to price every individual entity as a featured individual risk model. And that price should be more accurately reflecting your riskiness, and i.e. you are priced more accurately, and the company should be able to offer more cheaply priced products to most people. So it is time that we should try to adapt our techniques to remain at the forefront of this more precise underwriting. To be more specific, I think the profession needs to seriously think about introducing the latest artificial intelligence and data analytics subjects into our syllabus, our examinations. If the profession as a whole still lives like in 20 or 30 years ago, then one day we might suddenly find all of us obsolete. If we empower our new generation of actuaries with these useful data techniques, then they will be the people who know how to make best use of the data, and they will be the people who can integrate the industry with tomorrow. And this leads to other suggestion that we have. It might be in the profession and the industry's interest to open up data free of charge, rather than segregating ourselves from the rest of the world. Because today, the tech companies actually own more data than insurance companies have, and they have more technology power than we do. So it might be in our interest to integrate with this new regime rather than segregating. I would call the segregated case like a dinosaur in the digital age, which doesn't sound good. So several examples I can think of. For instance, banking risk models, in my view, are a bit more sophisticated than the insurance risk models, partially because the bank quants tend to come from a postgraduate numerical discipline where they got more exposure to the latest mathematical methods. So if we open up the data barrier, if we introduce new people into kind of peer review of our own processes, then we can potentially see new systematic thinking and modeling methods that we haven't used before. And another example we can think of is that if we use some mobile apps to centralize data, people's data into cloud space, then we are potentially getting much more amount of underwriting data, and that will enrich our actuarial modeling, and that will give us the potential ability to utilize big data technology to refine our product pricing. So we asked a question, do you think life insurers will become insurance tech companies in the next decade? And sadly, most people answered no. They don't believe in technology, basically. So what does that mean? I think that's a sad fact, because we actually ought to embrace the future, ought to embrace technology advances. What do you comment, Bertrand?
I think it depends on where you're coming from, because I think companies are now investing in these new technologies, but they're not really branding it as insurtech per se. So the impact would have been more visible if there were more successful mainstream examples that we haven't seen yet. So imagine the announcement by Amazon and others was not just for their 1 million employees, and they were still willing to do it on a non-profit basis. What would have been the reaction of the market then? Secondly, let's assume that those companies using wearables or other new technology is pricing out those who are not. How would the incumbent be able to compete with a company who can survive with more accurate and possibly more lower pricing? The World Insurance Report survey, there were two questions that was relevant to this one, saying a third of the consumers believe that they got a deal out of an insurtech company, and 80% of the companies are investing to develop these technologies. So the other question that we asked, who would you be relying to get health advice? So as expected, the GP is at the highest level, and then closely followed by family and friends, and then the health service companies developed or set up by Facebook, Amazon, Google, or Apple. And interestingly, the life insurer was the least preferred. So how do we think about that? I think so the result is perhaps a reflection of the existing experience of life insurance companies, the lack of touch points, lack of personalized solutions. So in a way, it is in line with our expectations. The insurance industry needs to do more to be a trusted partner of the consumer. And the results for FAGA, the Facebook companies, is interesting. Perhaps the market is not always right, and investors shouldn't have been alarmed to the recent news of Amazon with Berkshire and JP Morgan.
Okay, the next one is something more like a mind experiment, separating underwriting from funding. This is quite new, that I do not believe we have had much of such a business model before. But what does it involve? We believe that traditionally, insurers play dual role of underwriter and funding provider, capital provider. This means you have to have the money and you have to have the knowledge, which leads to high barrier of entry. But today's technology enables such a hypothetical case where all the underwriting and reserving activities are done by robot with little to no human intervention. And if you have such a platform run by itself as well as learn, then capital resources can be pulled from mass funding sources or alternative funding sources. For instance, private equity or other people that have money but do not have the actuarial knowledge. They put money into such a centralized platform run by robots and remain outside the insurance corporate framework. So what does this mean? This means that the insurance management and actuaries are 70% to 80% laid off because they are not very needed. And the cost saving and consumer value add are very obvious. If there are more funding parties and if there are less management and actuaries, then the consumer policy pricing could be much cheaper. So this is just a mind experiment, but I do think at some point we can see such form of business organization. And as a byproduct, we ask the question to the audience, because if you would like to set up such a automated underwriting system, then you need some very high quality underwriting data. So we asked the audience, are you willing to share your company's mortality data in a centralized environment with full confidentiality? And very encouragingly, 70% said yes. So this means we are quite open to sharing data as long as they are kept confidential. And this perhaps brings a message to the actuarial profession. So sharing should not be a problem. Okay.
So this mega trend is about customers. So millennials want everything they've been accustomed to in the new digital world. They want convenience, they want speed, personalization, and more importantly, increased touch points, whether this is during the application stage or the claim stage. However, you need to have them on board in the first place. So this takes me to the statement, customer experience is everything and nothing. With the advent of data analytics and other tools, it is perhaps more easily to engage with the customer and having them on board. However, I think there is more can be done. This is maybe more so for the mass and lower mass segments, which I will talk in a moment. Amongst our discussions within the working party, we thought the easiest way to buy a policy would be just downloading an app. No logging in, or no filling in an application form, just a single touch and an annual fee for the cover and the service received. The challenge with the millennials is their loyalty. In this transparent, ever-changing world, millennials can be rewarding as well as penalizing. But coming back to the traditional life office, so in reality, our business, our industry needs to do more in terms of improving their customer experience. To be fair, the old legacy systems and processes have prevented this to take momentum. In fact, each of these topics that you see on the slides is an opportunity to improve the touch points to meet the needs of different segments. But some will be more difficult to overcome, such as mis-selling. However, again, referring back to the World Insurance Report, there are some interesting results where incumbents are seen as more trusted and secure provider compared to insurtechs. But if you think about it within the trustedness of the insurance industry, against other sectors, I think that's food for thought for all of us. So, insurance industry has been focusing on return of capital by means of special dividends and share buybacks rather than growth. Why is this? As we've seen from the survey, the first question, we all agree that insurance industry is facing disruption. But yet again, there hasn't been sufficient investment cases to use capital to earn an acceptable return from it. Interestingly, today's announced $15 billion deal, the acquisition of Excel by AXA, is against this premise, where quoting the CEO of AXA, Thomas Burbel, that share buybacks is actually an indication of lack of entrepreneurial ideas. So are we really focusing on the needs of the consumer and maximizing value add? Do we need to have that prudence over prudence when designing products or propositions? Or maybe a question to the actual profession would be, how can we be seen as an internal part of the value chain rather than as a cost contribution? So an interesting way of enhancing consumer value is how efficient products are designed and promoted. I think the key takeaway from this slide is flexibility, just like a Lego toy. So modular products have been developed in some continental European markets, and some companies in the UK are following similar strategies. Modularized products can be effective in most segments, but I think, and we think, it may be more relevant for the mass market. Customers entering to the market will not be able to afford huge premiums, so low ticket size, such as sickness and death benefit. But once their financial well-being will improve, they will need higher covers, so the flexibility will start playing a role, so they will be able to add new covers on top of their existing simple product. So we've talked about the proposition, but we haven't talked about means of reaching to the consumer, the distribution. So the biggest advantage when you think about asset managers compared to life insurance is the sales and marketing costs. So potential would be to bring these costs down to the same level as experienced by the asset managers. So this could be done by harmonizing the price comparison website proposition, robo-advice, and maybe the advisors as well. So UK has seen a great advancement in terms of price comparison websites for the non-life products such as motor and home insurance, given the commoditized nature of these products. So robo-advisors could only operate within the algorithm that you've been defining unless you've introduced machine learning into the proposition. It seems that, again, the partnership with the insurtech technology and traditional insurers seems to be the way forward. And we tend to call it, within ourselves, the cyborg advisor. Since the consumers want to see increased touch points, it is imperative that the life insurance company should be ready to serve the customer anytime and anywhere. So there isn't a single moment of truth, and we are more talking about moments of truth leading to the final decision. So we asked the audience, who would you be relying to get financial advice from? So the results are very similar between the four choices. Family and friends are on par with IFAs, followed by the life insurer, and then the financial advisory set up by the FAGA companies. So our fictitious A-Life brand will face a challenge in terms of providing advice according to our audience. So this is my last slide before I pass for Zilling for final commentary. So lower income segments have not really been served in the developed markets, but more so in the emerging markets. The reasons for this may be the low ticket size of and the expensive distribution channels. However, we consider it as an important group to market and to create awareness because of the younger people who represent the future. If life insurance is irrelevant to them now, it might be difficult to consider later in life. The challenge of this business model is how do you make it work? So you need to have low unit costs. Claims management is a challenge, and underwriting, traditional underwriting, is almost impossible. The new technological advances, such as using both structured and unstructured data, can be a solution to think about underwriting. A good example of this is partnerships with mobile operators in Africa, where life insurance is purchased with mobile credits. Question is, would this work in developed markets? I just want to point out one thing. There is this conference call on the 23rd of March on microinsurance by the network of consulting actuaries. So if you want to find more, I would strongly encourage you to dial in and listen to the latest developments.
Okay, very quick conclusion. We believe that there are these mega trends due to not only socio-economic environment changes, but also technology advances, and they threaten to invalidate our traditional value proposition. We believe that the industry and the profession must treat them seriously. So our working party wish to raise awareness and have suggested, where appropriate, points of action for us to possibly adapt with these trends more proactively. Thank you very much.
Thank you.
Thank you for that. You mentioned things like data science, which is actually something that Council is actively looking at the moment. The discussion is now open to the floor. Who's likely to be asking a question? Would you like to put your hands up? We do have a few. We don't have long for questions, but I shall invite. There's a man that looks like Harry Taylor that was putting his hand up on my right-hand side, and someone's coming towards him.
Hi there, my name's Harry Taylor, and one of the things I do is specialise in innovation. I'd like to thank the Working Party for a really interesting, thought-provoking set of stuff. There's probably several days' worth of conversation and questions to be had on it, so I'll home in on one of them which intrigued me, and that was number 4, InsurTech, or InsurTech, I'm not quite sure how you pronounce it. So if life companies at the moment are dinosaurs in terms of InsurTech, what might, I'm thinking myself, what might the characteristics be of a new breed of Digisaurus, which might emerge as a life company that embraces fully digital? And I think there might be two models, and I'm interested to know whether the members of the Working Party agree with me, or if there's yet another model that could be adopted. The first one is simply to have some, or for the company to embrace the idea of agile innovation, use agile techniques and techniques of innovation, and recognise that there is a need to change the way they do things to produce better and more innovative propositions for customers. And the way in which they might do that would be to partner with small enterprises that specialise in digital and merge the two together. So that's one business model that says basically you keep the mothership intact, but you have something running alongside it, and at the appropriate moment you start to leverage it up, and you learn by doing. So that's one model. The other model I think is more interesting, and it's where I think there's a fundamental difference between a business which is a standalone traditional life assurer and a business that does life assurance as part of being a composite, which does general insurance and life insurance, because my sense is that the GI guys are light years ahead of life insurers in terms of digital interaction with customers. And as evidence of that, I'd give examples of Aviva's Digital Garage. L&G have partnered with a number of businesses and clearly leverage their GI stuff into the life side. But there may be other models. I'm not quite sure exactly how AXA do it. But I think that's interesting. And I think whether a life company survives or not longer term doing what they do at the moment. I think if they only do what they're doing at the moment, they're unlikely to survive long term. I think the pace of change will be far faster than most people are factoring in, and therefore I think all of the traditional life insurers, particularly the ones that are standalone, wherever they are in Europe or anywhere in the world, need to start thinking very fast about how they become Digisauruses. Do you agree?
Thank you. Yes, we do observe different business models between the traditional way and the new alternative way, but it's not a clear cut that the incumbents all follow the old way without looking at the new way. As you rightly suggested, there are advances such as Aviva's digital garage, where the large insurer works together with one or several startups to investigate the possibility of introducing new ways of underwriting, new ways of distribution into their system. And we do believe this is the trend, and this is the potential dynamics that keep the incumbents progressing rather than being wiped out. So when we use the term dinosaur, we are referring to the old way of building a underwriting model on a spreadsheet and then use it for 10 years. So we are not saying that the incumbents are all going to be wiped out like dinosaurs. I can give you an interesting example of what a new model might look like. There is a insurtech startup, I believe in the US. They ask users to submit their Facebook photos, and then they give you a life insurance cover pricing. So they use face recognition techniques to scan through your hundreds of photos. And depending on the time of these photos and your look in those photos, they can tell at what speed you are aging and what your lifestyle is. So no questions asked, just photos. This is one example. Another example is where InsurTech asks you for permission to your Google Map access. Then they see how you drive, especially when, for instance, you drive faster when there are no speed cameras around. Of course, there are other ways more widely known, such as installing a small machine, recording your speed. But now what I want to say is there's no need to do such complicated installing of machines. They can simply do it using technology. So you see, there are many ways that the conventional insurance model were not designed for. And we are living in an age where you see this gradual phasing out of the dinosaurs and the gradual introduction of new things. Birching, do you want to add?
No, I totally agree. I think it's best of both worlds. The partnerships between the incumbents and the insurtech. I think it was a few years ago. I think there was this thought that insurtechs will be the threat, but they can't. It didn't really pick up. So the way forward seems to be more in terms of partnerships.
Another question. There's one at the back.
Thanks, Ian Rogers. Interesting thing for me from your presentation, and to some extent linking to the With Profits presentation earlier, is about the life insurance industry traditionally has been quite focused on what customers can understand, what they should understand, how we should communicate with them. It sounds from what you're saying about some of the insurtech companies that a lot of that side of things is being put to the side. For example, if you're pricing a life insurance product based purely on face recognition, then clearly the customer's not being told a great deal about how that algorithm works. But it's communicated to them in a way that they can easily understand. They understand the idea that they must be aging, and they can see the extrapolation. So it seems to me that there's an opportunity for the life insurance industry to look at what it does well at the moment and the good modules out of its current products. So smoothing is raised as a potential good aspect of with profits products. Another aspect that the insurance industry has, which isn't really, is a big advantage over the insurtechs or the non-insurance companies providing an insurance-like service, is the capital, regulatory capital or economic capital backing the company and its financial strength. All of those things could be personalized and modularized using technology. So imagine you got to choose how much capital the insurance company held. Why does it have to be 1 in 200? Why couldn't I say, I'm happy for my insurance company to hold 1 in 20 capital? And if you could explain that to the customer in a way that made sense to them, then they could make an informed decision about how to go about it. So I guess my point is that insurance has a lot of good aspects, it's got a lot of good ideas, but we take a very top-down view of how that ought to be, partly by ourselves and partly by regulation and by common practice. I wondered if the Working Party had any thoughts on how we get out of that rut of thinking and look at ways to democratize the ideas and make them more personalizable.
Yeah, interesting question. You're more than welcome to join our Working Party. So I think in terms of customer choice, the level of capital, to be fair, well, it won't be fair in terms of competition. And given there's much pressure on the UK regulator around having the competition as a main idea, I don't think that would really go down well, because it will be an unfair approach to other competition. Yeah. So I'm assuming that was your question. Perhaps I'm not sure whether I've answered it, but.
I believe you also are trying to highlight the consumer touch point and how insurance companies, given that they are well positioned, how can they improve the consumer connection, if I understand correctly. So I think it all boils down to the unique time that we all live in. Traditionally, piece of paper, piece of letter is how you communicate. Now we are in a different time, and consumers, as Bertrand pointed out, they like something like an app. They like to be able to see on a daily basis. And we insurance companies all can explore better means of digitalization of our offerings. So it's a complicated issue. The overarching aim is to shorten the time frame from the consumer having an interest in buying something to he or she actually buying something. So I think that time scale is being reduced exponentially, and incumbents must work with insurtech startups, find out ways of joining this trend.
I fear our timescale has been reduced exponentially, and I now have to draw the discussion to a close at this point and invite Karen Brawley from Hyman Robertson, who's going to close for us this evening. She heads up the product services for life and financial services clients at Hyman's and has been working in financial services for over 20 years, covering a wide spectrum of actuarial roles in life assurance, asset management, pensions and banking. Karen.
Thank you, Alan, and thank you to both sets of speakers this evening for providing some very interesting presentations. We've also picked up some great thoughts from our audience tonight, so thank you to all of you for your participation as well. I'm hugely supportive of the profession, looking at things from the perspective of the customer. So I was delighted to hear these presentations tonight where the consumer view was taking prominence. As Tim outlined in his first presentation, there are often, unfortunately, negative stories which make great headlines for the papers, but not so great for our industry. Unfortunately, some of these examples are, where financial products have not served customer needs well. However, misinformation by the press can also be harmful, and I believe there's a great role for us as actuaries to play as educators and influencers to help in 3 distinct ways. I think we can help to ensure that the right products are available in the first place. We can also help to ensure that customers are able to fully understand their financial needs and the products that are available to help them achieve their financial goals. And finally, we can help customers to stay engaged and informed on how their products are performing and if they are continuing to meet their financial needs. And to do this, we must work with others in the industry, notably financial advisors and, of course, the FCA to achieve these goals. So from the first talk on with profits, I was particularly interested on the ongoing engagement part. Many of us in product development probably spend a lot of time concentrating on the sales process rather than the later stages. But as Ross outlined, a customer may have decisions to make further down the line, and the research backed up the concept that individuals can do with extra help at that time so that they can better evaluate their options. And perhaps this is where we can look at behavioural techniques or nudges, as Catherine brought out with the data science examples, to allow us to help present annual statements and decision-based communications in a way that are designed to help lead customers to an action or a decision, or at least to help them see that they have got choices to make. We then had a good discussion as to the main themes as to what customers might find useful. And I think Tim said it best when he said we need to find the right balance. Always a difficult thing to do, but that doesn't mean we shouldn't continue to strive. And I think that the Working Party will continue to help us identify what is working best for consumers. In our second talk this evening, we then heard about how the recent regulatory impacts have made life so difficult for us all in the industry, and how other economic changes have altered the financial situations of consumer groups. Leading from this, we then heard about potential threats to our traditional models and the way that life insurers currently write profitable business, and the ways that they might need to embrace change and the threats to create new opportunities for themselves. And I think the following discussion picked up some even more ideas as to how those business models might change. So my key takeaway from all of this was that there are a variety of ways that an insurer can structure its business model as we move forward. As Zilling touched upon, we have already seen some movements in the market with some large transactions, some continued consolidation, restructures, and sales of backbook portfolios. As Bershin mentioned, we are also seeing new partnerships between traditional insurers and insurtech players. And of course, the increased need for us all to continue to consider the digital capabilities. So it's an interesting time of continued change. And throughout all of this, I believe there will continue to be an important central role for our profession in the financial products world. I would agree with Zilling that we have to, as actuaries, show flexibility and a willingness to embrace new ways of working. But for me, the most important thing that doesn't change, and that is our need to continue to look at the impact and value of what we are doing on behalf of our customers.
Thank you, Karen. With that, can I remind you that the next sessional meeting is due to be held here on Monday, the 21st of May. It's likely to be a pensions topic, but hasn't been fully agreed yet. Tuesday, the 1st of May, will see the next lecture in our professionalism series. Dr. Daniel Suskind will deliver a lecture on the future of professions. Threats once again to us. Perhaps he will use the word Digisaurus. That lecture will actually take place in London, but there will be live streamed to the EICC here in Edinburgh. And if you're mad enough to come to it, you'll discover it's me chairing it as well, so I'll probably put you off. With that, it remains for me to express my own thanks, and I'm sure the thanks of all of you, to our authors, our closers, and those who've participated in this evening's discussion. Please show them your appreciation.